last time we were together, we talked about fiscal policy, contractionary and expansionary policy, and how it affects graphs and stuff. But now I want to get into some specifics about taxes and spending and some of the implications of that stuff. So I want to start off with government spending. Government spending includes anything, transfer payments are included in that as well, or goods and services payments. So like goods and services might be like, building a road or spending money on the military, whereas transfer payments would be Social Security, Medicare, or Social Security, maybe not necessarily Medicare, but like Social Security, unemployment benefits, things like that. That would all be parts of government spending. Now, another thing I want to discuss is the difference between what's called non-discretionary and discretionary. You need to know the difference between those two. Discretionary means the government has a choice every year on whether or not they want to spend that money. It's up for their discretion, right? It's their choice. So that would be like things like military spending, stuff like that. Stuff that when the government passes its budget every year, they decide how much they want to spend on that thing. That's discretionary spending versus non-discretionary, which is the government doesn't have a choice. They have to spend it. They're required by law to spend that money. So, for example, Social Security payments are non-discretionary. The government has to spend that money because it's a part of the law, right? So, for example, when you get old enough to draw Social Security payments from the government starts giving you Social Security. They don't have a choice. They don't pass a law whether or not to give you, or they don't change the budget every year to give you that money. Like the government's required to give you that money according to law. What's the government spending its money on? Some things they're spending their money on: Social Security, national defense, income security, net interest on the debt. So the government owes a bunch of money, right? So they got to pay that money back plus interest. So the interest they pay on the debt. Medicare, healthcare spending, stuff like that. You don't have to know any of these topics, these specific categories. It's just, if you're curious what the government spends its money on, that's what they're spending the money on. Now, we've talked several times about the difference between the deficit and the debt. Again, what's the difference? The deficit is for 1 year. The debt is the total amount of money that the government owes. You don't have to know anything about the history of the deficit or the debts. We have some very, very large deficits right now, like incredibly large after that $2 trillion spending bill was passed for the coronavirus stuff. Like our deficits are massive now, like some of the largest in our history compared to the size of our economy. Remember that the government sells bonds, right, to people. They issue bonds to make up for that debt. So people owe they owe money. And the government owes money, and they issue those bonds to make up for that, right? So that's how they get their loans. The debt right now is pretty large. We've looked at it before, I believe, but I'm going to show it to you again. So this is off of that website that I just showed you on the PowerPoint slide. This value right here, this is our, these are estimates, right? They're not exact, right? So when the government passes a budget, they already know that they're going to have a debt, but they're already going to have a deficit for that year. All this is doing is taking the projected deficit of the year and dividing it by seconds in the year to give you an idea of just how fast it's growing. But this is our total amount of debt, right? This is the total amount of debt we owe, $24 trillion, okay? And this is our deficit right here, okay? Now you see right here, this is actual versus official. The reason why there's a difference is because of the way Social Security and stuff like that is calculated. So Social Security, I think, is technically not on the budget. So this is, the actual amount of money that we have in deficit for this year. This is the official number. Okay, don't get too bogged down in the difference. Okay, but I just wanted to point that out. But yeah, we have a massive amount of deficit this year. Okay, so the deficit this year was already going to be like $1 trillion. Now it's going to be way more than that because of the coronavirus bailout stuff that was passed. So we have a massive amount of deficit for this year. So our total debt is $24 trillion. We're probably going to have a deficit this year of over $3 trillion to give you an idea of just how massive the spending is right now. So yeah, you can, and if you go to that website that's linked here, usdebtclock.org, you can look at all kinds of other data on there. And if you roll your cursor over the data, it'll tell you kind of an idea of what exactly that data is. So yeah, That's the deficit of the debt. Remember, the deficit is for 1 year. The debt is all deficits combined. About 2/3 of the taxes that our economy, or that we pay, about 2/3 of that tax that we pay goes toward the federal government. About a third of it goes to the states. The largest source of revenue for the federal government is the individual income tax. Another big source of revenue for the U.S. government is the payroll tax. That's the tax on that the government uses to pay for Social Security and Medicare. If you ever look at your check stub, you can see all this stuff. You'll have like a section on there for U.S. federal income taxes, and then you'll have another section that'll probably it'll either be called payroll tax, or it might be called Social Security tax, or it might be called FICA, F-I-C-A. Those are all taxes that we use to pay for Medicare and Social Security. And then we also have excise taxes, which are taxes on a specific good. So, for example, there's an excise tax on cigarettes. There's a special tax on alcohol, on gasoline. I want to take a second. Excuse me. So, So I want to take a second, okay, and I want to show you guys. Not that. I want to show you guys my paycheck to give you an idea of like what it means when we say, like when we talk about like all these taxes and stuff that you pay. So this is actually my paycheck. This is, if you look on here, right, 331. So this is the paycheck that I just got 2 weeks ago. Okay, and I want to show you a couple of things. So right here first, gross pay, right? So my gross pay is $6,907 for 1 month. This is all for 1 month, right? Now you might be like, wow, coach, that's like an insane amount of money. Like you make a lot of money. Okay, guys, that's before taxes and all the other stuff that I have to pay every month. So that's not what goes into my bank account. Okay, what actually goes into my bank account is this number right below it, $4,279.64. That's what actually goes into my bank account. All right, so that's a huge difference, y'all. So you might be asking, okay, where's all that money go? Well, I'm going to show you where all that money goes. So if you scroll down here, you can see what it is that gets taken out of my check. So these are the deductions that are taken out of my check. That comes out of that 6,000 number. Okay, so where does it all go? Well, all right, let's look. All right, if we go down here, federal income taxes. This is the federal income taxes that I paid for 1 month. $925 for 1 month, y'all. 1 month. Okay. The state government of Georgia has its own income tax that I also pay every month. That's this number, $332. So in just income taxes, we're talking like $1,200 to $1,300 a month that I pay in just income taxes. Then we have Social Security and Medicare taxes, right? What I was telling you earlier, the payroll tax. That's $413. And then Medicare tax, $96. So in just taxes, y'all, I pay what? So like I don't know, $1,350-ish, $1,350 plus another $500. So in just taxes, I pay like $1,700 a month, y'all. $1,700 a month. Then what about the rest of it? Well, you know, health insurance, all that kind of stuff I have to pay. $135 a month. These are all for 1 month, y'all. Okay. Health insurance, and that's like a really low number for me, okay, because I'm single and don't have any kids. So like your parents or like other teachers who are married and have kids, their health insurance is like close to double that, right? Dental insurance, $45 a month. Vision insurance, $6.58 a month, okay? Then I have my own healthcare spending account that like is like a savings account that I have that has like special tax benefits and stuff. So like that's this right here. That gets taken out of that check every month. Now, I can use that money to spend on like healthcare costs, like buying prescriptions or paying like a copay when I go to the doctor and stuff like that. Okay, but I can only use it for those purposes. I can't use it to spend for anything else. All right. Then I want to retire one day. So where's that? Well, this is Teacher Retirement Systems of Georgia. Okay, $414 a month. I pay into that every month. Okay, now hopefully I'll get that back when I retire in the form of a pension, but that's not guaranteed. It's only if the state government of Georgia continues to keep the same like policy they have right now. So what I get right now is when I retire, they'll take my 3 best years as a teacher and they'll average them together, and they'll give me 60% of whatever that average is for the rest of my life. So like hopefully I'll get that back. But the state government of Georgia could change their mind, and they could change the law, and I wouldn't get that money. But hopefully that's not going to change. Then I have my own retirement account that I manage that's outside of TRS. That's like my money personally. I put $200 a month into that for a total amount of deductions of $2,627, right? So like that's what gets taken out of my paycheck every month. So what actually goes into my bank account, that's what goes in my bank account. Now you might say, well, like $4,200 is still a lot of money, Coach Green. Well, yeah, but I also have to like pay to live, y'all. So like my rent every month is like $900, right? Plus I have to pay my gas bill, my electric bill, my cell phone bill. All that stuff is in my name. I have a car payment, right? That I got a loan to buy. I got a loan to buy my car, so I have to pay like $400 a month for my car payment. I have to have insurance on my car. That's like $100 a month. I have to buy gas for my car, right? So that $4,279 sounds like a lot of money, but after you pay for like your living expenses, that takes care of a ton of that. So the reason why I'm saying all this stuff is not to make you depressed, y'all. It's to just give you an idea of like what the real world looks like. Now, it's not all bad. Okay, so for example, like if I want to go out tonight, assuming that we weren't in the middle of a quarantine, I could do that and stay out as late as I want because I don't have to go tell my parents, right? Because I'm like in charge of my own life. So, there are benefits to having to spend all this money. Okay, not living with your parents, right? But like I'm just trying to give you an idea of like what the real world looks like. So one day when you guys graduate from college, you're going to get a job, and they're going to tell you, hey, we're going to start you out at like $50,000 a year. And you're going to be like, oh my God, I'm going to have so much money. Okay? You need to like think about that, guys. Like 25% of your paycheck is going to go straight to taxes. So if they tell you you're going to start out at $50,000 a year, you need to cut 25% of that $50,000 out immediately because you're never going to see it because it's going to go all to the government in the form of taxes. And then start figuring out from there like where the rest of your expenses are going to go. So anyways, that's a little taste of the real world, y'all. All right, now moving on. Still talking about taxes. When we talk about taxes, we can talk about different principles of taxation. The benefits principle, which basically just means that like if we're gonna build taxes, we need to figure out a philosophy on how we're gonna build them and like how we're gonna set those taxes up. Well, the benefits principle says that basically people who pay taxes based on the benefits they receive. So like the more benefits you receive, the more taxes you should pay. Okay, the more taxes you should pay for those benefits. All right. So like that's what the benefits principle of taxation says. An example of that would be like gas taxes, right? So like there's taxes on gasoline. So like the people who drive on the roads the most, those gas taxes should be used to pay for the roads to maintain them and stuff. They're going to buy the most gas, so they're going to pay the most taxes. That's the benefits principle. The other principle is called the ability to pay principle, and that says that people who have the greatest ability to pay should pay the most in taxes. Right? So, basically, like, what that's saying is, like, wealthy people should pay more in taxes, right? Because there's an important assumption that you have to make here. And the assumption is that people who are wealthy suffer less when they pay in taxes than people who are poor. So, for example, suppose, like, I make $20,000 a year and I pay 10% of my income in taxes, so I pay $2,000 in taxes. And a millionaire makes $1 million a year and pays 10% of their income in taxes. They pay $100,000 in taxes, right? Well, obviously that millionaire pays way more taxes than I do, but that millionaire still has $900,000 left after they pay taxes, so they're still going to live a very comfortable life. If I pay $2,000 in taxes, yeah, that's not very much, but if I make $20,000 a year, I'm like in poverty, y'all. Like I'm officially considered to be in poverty according to the U.S. government. So that means that most of my money is going to go toward necessities. So when I pay my $2,000 in taxes, that may mean I may not be able to afford like food, or I may not be able to afford rent or a house or a car to get to my job, right? So that $2,000, while it's way less, it has a much greater impact on my life than it does for that millionaire, even though that millionaire pays more. So therefore, based on that, the millionaire should pay more in taxes. That's the ability to pay principle. Now, when we look at the ability to pay, we can talk about what's called vertical equity and horizontal equity. Vertical equity just means that those with greater ability are going to pay more, right? So people with higher incomes pay more in taxes. Whereas horizontal equity, within vertical equity, let's talk about three things. This is something you really need to make sure you know, guys. You can see this on the AP exam. This part right here, specifically. Proportional tax means people with, that means that like everybody pays basically the same percentage of their income in taxes. Regressive tax means poor people pay a higher percentage of their income in taxes, and progressive means the wealthy pay a higher percentage of their income in taxes. There are examples of taxes for all of these. Proportional example would be like the flat tax. That's a tax that's been proposed by people before. Flat tax just means that like everybody pays the same percentage. Regressive example of that would be sales taxes. because people who are, like, if you both go to the grocery store today to buy $100 worth of groceries, the person who's poor is going to pay a greater percentage of their income, right? Because they're going to pay like $6 of their income versus $6 out of the millionaire's income. That's going to be a much lower percentage.